Welcome to the Skilled MBA Finance Case Study Series. In this episode, we examine how Right Tight Fasteners Private Limited navigated financial turbulence during the COVID-19 pandemic. As liquidity ratios declined and cash flows tightened, the company faced a pressing need to reassess its financial strategy. Leadership focused on cost control, streamlining operations, and maximizing efficiency to weather the storm and preserve business continuity. This case provides valuable insights into crisis management and financial resilience during uncertain times. Right Tight Fasteners Private Limited Lati is a 30-year-old family-run manufacturing business specializing in industrial fasteners. Known for its established market reputation, the company operates on a low-margin, working capital-intensive model. Historically, it has managed tight liquidity through strong supplier-customer relationships, crucial for navigating financial challenges. A 30-year-old family-run business specializing in industrial fasteners has built a strong market reputation. Operating on a low-margin, working capital-intensive model, it relies heavily on tight liquidity and robust supplier-customer relationships. This approach has historically sustained its operations despite financial constraints. The industrial fastener market in India, valued at 120 billion rupees, experienced 8 to 10% annual growth pre-pandemic. However, reliance on steel as a primary raw material exposes businesses to price fluctuations. The market is highly competitive, with price sensitivity and extended payment terms from major clients adding to the challenges. COVID-19 severely impacted the industrial fastener market. Manufacturing halted, customer orders plummeted by 60%, and steel prices surged by 25%. Extended payment cycles exacerbated cash flow issues, despite efforts to maintain vendor reputation and pass on costs. The economic slowdown intensified these challenges, straining financial stability. Analyzing key financial indicators, pre-COVID, the company maintained a healthy cash flow with stable inventory turnover and receivables period. Currently, the cash conversion cycle has lengthened, impacting liquidity. Inventory levels are high, and receivables collection has slowed, exacerbating cash flow issues. Understanding these shifts is crucial for addressing the liquidity crisis effectively. The liquidity crisis stems from an inventory buildup with excess stock and slower turnover. Extended receivables have increased the payment collection period from 45 to 75 days. A 60% decrease in sales volume has impacted cash inflows, while fixed debt obligations persist. The core issue is liquidity, not profitability. The working capital analysis reveals 42 million rupees in current assets, mainly inventory and accounts receivable, against 18 million rupees in current liabilities, including accounts payable and short-term debt. The cash conversion cycle stands at 120 days, indicating a lengthy period between paying suppliers and collecting from customers, impacting liquidity. Crisis management involves short-term debt restructuring by negotiating moratoriums, reducing interest rates, and extending repayment schedules. Inventory optimization is crucial. Liquidate excess stock, identify slow-moving items, and adopt just-in-time procurement. Renegotiate credit terms by reducing customer payment periods and extending supplier credit to compress the cash conversion cycle effectively. Implement a 6-month principal moratorium and reduce interest rates by 150 basis points. Extend loan tenure by 18 months and convert short-term credit to medium-term loans. These measures aim to improve the debt service coverage ratio from 0.9 to 1.25, enhancing financial stability. Conduct a comprehensive SKU-level analysis to identify excess, obsolete, and slow-moving items. Offer special discounts on non-critical inventory to convert to immediate cash. Shift from bulk purchasing to smaller, frequent orders aligned with demand forecasts. Implement consignment arrangements with key suppliers to reduce capital tied in raw materials. Aim to reduce inventory holding by 40% within 90 days, freeing up approximately 10 million rupees in cash. Introduce early payment discounts to incentivize faster payments and implement stricter credit controls for new orders. Negotiate revised terms with major accounts and deploy digital invoicing to minimize delays. Request extended payment terms from suppliers. Develop a payment prioritization framework. And explore supply chain financing to reduce the cash conversion cycle from 120 to 75 days. Phase 1 focuses on immediate actions like bank negotiations and cash flow forecasting within the first 4 weeks. Phase 2 involves executing inventory reduction and optimizing processes from weeks 5 to 12. Finally, Phase 3, spanning weeks 13 to 24, emphasizes monitoring and adjusting strategies for long-term stability. Profitability doesn't guarantee liquidity. A business may appear profitable yet struggle with cash flow if working capital is mismanaged. Monitoring the cash conversion cycle, the time between paying suppliers and collecting from customers, is crucial. Building liquidity buffers and maintaining financial flexibility are essential for resilience, especially in manufacturing where operational agility impacts financial stability. Thank you for joining us at Skilled MBA. For practical financial analysis training, Skilled MBA offers a wealth of resources. Access case studies and expert guidance by contacting them via mobile at +91 87553-00795 or email at support@skilledmba.com. Explore their offerings further on their website, https://skilledmba.com, to enhance your financial acumen.